Hey, good morning, everyone. So today, I just wanted to talk about a couple things before I start the training. So first, yesterday for Canadian agents, during the product on Thursday, there was a training about compliance. So if you were not able to join live, please watch the recording. Compliance is a very important part of what we do, and there's a lot of really good information that you need to know. So please watch the recording. I haven't checked to see if it's in the back office yet. Typically, they put it there the next day. But if not, at the very latest on Monday, it should be in there. So today, I wanted to talk about objections, handling objections, because, when it comes to sales, we're always going to come across objections. So I'm going to start by just talking about the most common objections, that we tend to go through, get in our industry. But then I want everybody to share their own experiences. And if there is, objections that you've had to deal with, you can bring them up. And that way we can all help each other on what you did to handle that objection. The first one, well, there's like three main ones I find, but I think number one might be the cost concerns. So a lot of people feel that life insurance premiums are too expensive and it might not fit within their budgets. So to handle that objection, the best way is to avoid it completely. When you do the financial needs analysis first, then you get to know what their budget is. So if you already know what their budget is, then you can make sure that you stay within that budget. And it's about choosing the proper type of insurance. If somebody doesn't have a big budget, are we going to sell them a whole life policy? No. Whole life is it's an awesome product, but it's an expensive product. So they will not, if their budget is small, they're not going to have the amount of insurance they need for that premium, right? So we might want to go more for a term policy. And it's important to let our clients know that these term policies are convertible. So right now, that your budget is tight, we can start with a term policy. And in the future, whenever your finances are better, we can convert this to a permanent product. So yes, when it comes to cost, from my experience, the best way is to find out their budget first. That way, you won't have that objection because you already know, you already agreed with them ahead of time. Okay, so you would feel comfortable with this amount every month. Another objection, that we often get is people might think that it's not necessary or that it's not a priority at a current stage in their lives. So again, it's important when it comes to that, it's important to let them know that this is the time to get it, right? You're young, there's no way you're getting younger with time, right? So you're never going to be younger than you are today. And maybe you're healthy today, but we don't know what can happen. It could just be next month, next week. You never know when your health could change. Or you get into an accident and, then you become disabled. Then it's going to be very difficult to insure you. So it's about emphasizing the importance of life insurance to also protect your loved ones. I've come across cases where people have literally told me, well, what do I care? I'm going to be dead. And they had families, like they had a spouse and children, and they would say that, well, I'm going to be dead. What does it matter to me? That, it's a little bit selfish. But when that happens, if you're sitting with a couple, then look at the spouse and say, well, how do you feel about this, right? And the thing is, when it comes to life insurance, spouses need to know that they can be the owner of the policy for their spouse's life as well. Because it will happen sometimes that, one of them is like, well, I don't care about this. But if it's really important to the other spouse, they can just get the policy themselves. Their spouse will be the life insured, but they will be the policy owner and they will be the beneficiary. We can own a policy on somebody else's life when there is a financial risk. I cannot buy a life insurance policy on my neighbor's life, for example, or a cousin, or, someone like that, unless I can prove that should they pass away, it would impact me financially. But a spouse, that's very easy to justify. So you can get that policy. Sometimes another objection is because people might feel overwhelmed with all the information you shared, and it's not clear to them. They don't fully understand the product. And when people don't fully understand it, it'll make them hesitate into making a decision. So it's very important that when we present our options to our client, we keep our language very simple. Don't start talking about riders, cash surrender value. Like, you can use those terms after you've explained them, but just not out of the gate like that. We have to remember that even just saying term life to a client, they might not understand what that means. So we need to make sure we use simple language that makes everything, very easy to understand. That way, when we're providing that clear and transparent information, and this will alleviate that confusion for them. Okay. And when we say something, when we're explaining something, it's okay to ask our clients, so does this make sense? Do you understand this? And they need to feel comfortable asking us questions. We need to let them know that there are no stupid questions, because sometimes people are afraid to ask a question because they're like, oh, well, that's going to make me look dumb. She just explained it to me and I still don't understand it. I feel embarrassed. So it's important to let them know this might be foreign or new to you. My job is to make sure you understand. So please, any question, never, ever hesitate to ask. Okay? They need to feel comfortable asking us those questions. Another objection that comes along, this is typically with younger people, is they feel invincible. And they're like, well, I don't need life insurance. I'm not going anytime soon, right? That will happen a lot, especially with younger people. And I've seen it again and again. A lot of people, unfortunately, think that way. And I have people coming up to me, and now they're in their 70s, and now they're starting to think about life insurance. And then when I give them those quotes, they're like, oh my gosh, like, I'm better off just putting money in a savings account every month, like, this is just too expensive. But it's because they waited too long. So it's important to explain how, yes, okay, you're healthy, and yeah, the odds are you're not going anywhere anytime soon. But this is the perfect time to buy life insurance. You're young and healthy. It'll never be cheaper than it is today. And should something happen, you're protected, because we never know, right? We never know what could happen. And a lot of life insurance policies in the US, for example, many policies have living benefits built in. It's not even a rider on the policy, it's built in. In Canada, like with Beneva, we have the extreme disability benefit that's built into their policies. But on other policies, we can add a critical illness or a disability rider on those policies. And those are things that can happen at any age. And with critical illnesses today, you know, in the past, if you would get diagnosed with cancer, you know, a lot of people did not make it. But more and more people are surviving now because treatments have improved. So, but it doesn't mean that because you're going to survive, that while you're going through the treatments, while you're recovering, you're going to be able to work the same hours you're working today. So those are very important. So, you know, we can add those to that policy. Regardless of the age, those additional benefits are very important. And it's always, we should always offer them to our client. Even if they just ask for life insurance, it's important to bring the conversation up. And they talked about this yesterday in the compliance training, how, you know, there was this woman who purchased life insurance. The agent had offered the critical illness rider. The client refused, but then further down the road, the client developed a critical illness, contacted the agent and said, hey, I just got diagnosed. What do I get? And the agent said, well, you had declined that coverage, so you don't get anything. Luckily, but then that client was upset and placed a complaint against that agent. But luckily, that agent had kept detailed notes of that case. And, you know, when people are refusing a certain type of coverage, you can even make them sign something. Just like, you know, when you buy a plane ticket, for example, it'll offer you some coverage. And you have to check this box, said, no, you know, I'm not taking this insurance, and, you know, I'm aware of the risk, blah, blah, blah. You need to check a box. So you can do the same with your clients and get them to sign off saying, no, I don't want this coverage, so it can't come back against you later. But at the very least, keep very detailed notes, because this can happen. But yeah, coming back to those young, healthy individuals, those living benefits sometimes will have a bigger appeal to them than the life insurance, because the death in their mind is like so far away that they don't get the why. But you can show them, you know, the illustration. Okay, so today you are in your 20s. This is how much it would cost for this amount of coverage. If you wait, I don't know, 10 years, this is how much it would be every single month for that same amount of coverage. And they need to understand that that cost, it's locked in, right? It's not going to change. Oh, I just saw that there's a comment here from Kemi. Sorry, I'm on my iPad, so things don't pop up the same way as on my laptop. So you have a potential client who has a fixed budget for premium per month, but doesn't like term, because even though she can convert later and no medical, costs will be higher due to being older. Yes, that is true. When we do convert, because she is older, he or she is older, the costs will be higher. So how to overcome that? Well, yeah, that's a difficult one, because the thing is, if we get them that permanent product right now, yes, we're locking in that cost, at today's rate, but she might not have the coverage that she needs within her budget. So she's currently 35. You could also layer it, right? That's another way to reduce the cost. You could, I read your mind, Jane, just as you pressed enter. So yeah, you could do just a smaller amount of permanent with a term rider to try to get her more coverage and stay within that budget. And that way, especially when somebody has young children, it's important because you have those financial dependents. It's important to have more coverage. Whereas when we're older, if we live a long life, chances are, okay, not always, but chances are we should have less debt as we're older. And then our children, for example, should be financially independent, so we won't need as much coverage. And at that point, if the home we were living in, for example, needs to get sold because the money is needed for the people left behind, it's not as big of a, emotional impact as when you have young children and now the other parent is left to be a single parent. And on top of that, now they need to uproot their children, sell the home, move somewhere else, maybe have to switch schools. So having the higher coverage when the kids are little is more expensive. So you could look at layering, doing a portion of it as a permanent product. It could be 25,000, 50,000, whatever, depends on the budget, of course, and then have that term rider. And again, that term rider could be converted later, but at least they have some permanent insurance that's locked in at their age of today. So I hope this helps, Kemi. And I want to make this interactive. So if anybody has come across this and they have ideas or ways that they've handled this objection, please feel free to just unmute yourself and say it. Because since I'm on my iPad, I can't see any of you. And I don't know if somebody would have their hand up or something. Okay, so you could just unmute yourselves. So when it comes to, so we were talking about the objection of, when people think, I'm young, I'm not going to die. So showing them those comparisons and how they will see that in the long term, they're going to save a lot of money doing it at a younger age. Sometimes another objection that I've come across a lot is people already have some coverage, especially like through their work. And they're like, but I already have life insurance. I already have disability insurance. And then I will ask them, is that privately owned or is that through their work? They're like, oh, it's through my work. And through my work, we have these great benefits. I always say, well, that's awesome. That's great that you have those benefits. And it is. But should you switch jobs? Should you get laid off or fired? When you retire, those benefits are gone. And whenever that day comes, well, automatically, number one, you're going to be older when that day happens. There's no way around that one. But your health might have changed as well, which would make it more difficult for you to then get the coverage that you need. If you have, depending on the health issue you have, you might be limited to guaranteed issue. And the maximum would be like 50,000, which for many people is insufficient coverage. So it's important for them to understand that although they have those coverages right now, they're borrowing them. They don't own them. It's kind of like they're renting it. and they don't know when they're going to get evicted kind of thing. It's a temporary thing. So very important for them to have their own policies. Then it's locked in at today's price and they don't need to stress. They have those for as long as those, if it's a permanent product, they'll have it their whole life, regardless of what happens to their work. And I always like to tell my clients to see those work benefits as a bonus, not as the plan that they are relying on. And typically, when it comes to life insurance, when it comes to group coverage through their work, most times they are not sufficiently covered. Many companies, some it's like a fixed amount. It'll be like 25, 50,000 of coverage. And the most that I've seen was 2 years income. That's the most that I've ever seen in a group coverage. And if you have young children, 2 years income is not sufficient coverage. It's better than nothing. Don't get me wrong. It's better to have some coverage than none, but it's not sufficient because those children will need much more than 2 years. So those are the ones that I have here. Oh, one that I forgot that I want to include. Often, you've seen 100K, in the oil patch. Yeah, you will see that. But again, for a family with young children, still not sufficient. Their mortgage is probably higher than that alone. Never mind the income replacement required for their family. The objection that this one's easy to avoid is if you have a client and they are married, or in a committed relationship, they live together, they share finances. When you meet with them, you want to try to meet with both people. Otherwise, what will happen, like 90% of the time, is they will say, well, I need to talk to my spouse and get back to you. And that will often end up in them not getting back to you. And the spouse was not there, didn't fully understand the product, so the spouse will talk them out of it. So you want to meet with both of them because it's important for both of them to understand the coverage. And sometimes they'll say, yeah, but the insurance, my spouse is not interested in getting the coverage. This is just, I want to get it for myself. But then if something happens to you, then your spouse is going to be the one who's going to have to do the claim and everything. So it's important for your spouse to understand the coverage that you have. It's important for your beneficiary. Well, if your beneficiaries are minor children, then you will have, what's the name? You will have a trustee for that child. So whoever the beneficiary is or the trustee of the beneficiary, it's important that they understand what you have as coverage. So when it comes to a couple, very important to have both of them there. Otherwise, that's the easiest way for them to get out of doing it right now, is I need to talk to my spouse. Also, yes, I need to talk to my financial advisor. Yeah, I've had that before as well. And then it's like, okay, how long have you been working with your financial advisor? Have they ever talked to you about insurance before? Because often financial advisors will only do like the investment part. I know, for example, like in Canada, the company like Investors Group, many of their agents only focus on the investment side of things, and they don't look at the insurance. And we all know that insurance is the foundation of a solid financial plan. And so if they say they need to talk to their advisor, ask them the question, has your advisor ever brought this up to you? Have they ever spoken to you about insurance and how it is the foundation of any solid financial plan? And then you'll see what their response is. If the response is no, well, then maybe their advisor doesn't know much about insurance. So maybe they're not the best person to ask. And it's important to explain to them the why, that why insurance is the foundation of any solid financial plan. And that is because insurance protects us against unexpected things. You know, you might have investments, and, you know, it might be a significant amount of investments that you have. But if you become disabled for a year or you have a critical illness, how quickly are you going to use up those investments? Because right now, maybe you're on track for retirement. But if even for just 6 months, if you start pulling money out, you're going to be pulling out more than what you typically do as a monthly contribution. Definitely. And when you pull money out, you're affecting that compounding interest. And pulling out your living expenses for 6 months might delay your retirement by 10 years or more. Like, it's very significant if you start digging out of those investments. So that's why it's very important for them to understand why, yeah, investments are great. You also want to have that emergency fund, but that emergency fund is only to hold you up for a few months. If you have a critical illness like cancer, you don't know how long you'll be in treatment for. It could be a year, it could be more. A disability as well can last a long time. We don't know. So we want to be protected. So yeah, I also like to ask people who say I have investments. Yes, I ask what they think their most important asset is. Yes, they often will say their house, their car, but yes, it is their income. That is their most important asset, their ability to earn that income. Because without that income, well, everything else they might lose. And that's what critical illness insurance, disability insurance, and life insurance are. They're insurance for your income. They're income insurance. Just people don't hesitate buying insurance for their phones, but everybody has car insurance. You know, we can't drive around without car insurance. They have home insurance, but they don't have that income insurance. And that is even more important, because that's what makes everything else work. So it's only 10:30. So those are the objections that I had planned to talk about. I would like to invite you to share any objections that you have had, or any objections that you've had and you've successfully dealt with, or objections you've had and you're looking for help or advice on how can I handle this kind of objection.
I think you pretty much covered. Yeah. Sorry, Princess.
No, go ahead.
Oh, no, I was just going to say, I think you pretty much covered all the major ones. I mean, everything sort of falls under these.
Did you have one you would like to share, Princess?
So probably for me, I just would like to add to it is expensive. For some people, probably, I ask, what do you mean when you say it's expensive? Because they might have a quote from another agent, or maybe they are comparing what they had quoted from a few years back.
Yes, or sometimes too, it'll be like, oh, well, my friend or my brother, whoever just got insurance and they're only paying this much. But then they're not telling you that that person's 10 years younger than they are.
Yeah. They,
Yeah.
yeah, that's true. They compare prices. Well, they didn't even know what are the factors that affects the insurance premium.
Mm-hmm. Mm-hmm.
I have
Yes.
one.
Yes, Jacqueline.
So I had a couple, a client from my practice company, and then late last year, I was talking to them because they're my neighbors, so we talk all the time. So they asked what I could find for them. So I know their budget is very, very tight, and they wanted to keep it approximately the same price as the policy they had with the practice company. So I designed a really good program on Beneva. It was a term, and then I explained how we can convert the term later once their income stabilizes, because it's only her that's working, and what he does for work is trade stocks and things, and that's not always
Yep.
the most even of
It's not the most predictable, safe
exactly the
income.
up
No.
and down.
Yes.
So they really, really liked, they sent me an email after our meeting that they said they really, really liked what I had built for them.
Presented.
And
Yeah.
then they said, oh, we'll cancel our policy from the other place, and then we'll sign up with you.
Oh, yes.
Yeah. So
No,
they
never cancel before.
and I told them, I said, you don't want to cancel before you get a new policy in place, because that leaves you unprotected. Anyways, they were quite adamant that they wanted to cancel the other place first. So they called them, and they were sent to a Zoom with a sales manager. And of course, he convinced them by giving them a few little extras. He convinced them to stay with that company. And then, I contacted them a few days later, and they said, no, we don't like term. It's temporary. And I'm like, okay, I explained all that. So, yeah, so they stayed with the practice company, unfortunately, because, and I was kind of sad because what I had built was way, way better than what they
Yeah.
have now, even with the little bonuses that they were given to stay.
Mm-hmm. Yeah. Sometimes people just, that one little add-on, that one little like made it feel special for them or something. But yeah, it's people don't understand how, because I remember that client because we had discussed it, and they were going to be getting a lot more coverage
Oh,
for the
so much
same,
more.
and they have children, they have financial dependence. Yeah, it's like, okay, so what if something would happen tomorrow? Is your family gonna be with just that amount that you have over there, right? What's more important to you? To just know that with that other company, you have just enough for your funeral and final expenses?
Not
Or
even.
not even? Okay. Okay, well, they're not sufficiently covered. Yeah.
And so I was talking to the wife, because we go out occasionally, and she said, well, we don't need that much money for a funeral. And I'm like, "Ugh, it's not for the funeral, it's for the
It's
people
for,
that are left behind."
yes, yes.
So
What if something happens to you, and right now she's the only like steady income earner? What would happen to her family and loved ones if something would happen to her? Like if you would do just the short, like the light financial needs analysis, it'll tell you the recommended amount of coverage. So based on that, the plan you probably showed her was probably still lower than the amount they truly need.
oh, definitely. But I
So
had to be within their budget.
yes, of course. But it's like, okay, but with my plan, this brings you at least closer to the amount you actually need. Whereas now you have like like this is just a drop in the bucket. Mm-hmm.
And in my opinion, what I had originally sold them with the practice company was kind of expensive for what they got.
Yes, I know, because I know which practice company you're talking about. I was with them for 6 months, and they have one product that's very well priced, like that hospital living benefit, but their life insurance portion of the plans they offer is very expensive. Every single time, like every policy I've seen from them, I can, even if like 5 years have passed, I can always get them way more coverage for the same price.
Yeah, you have to pay for a lot of parties if you buy a policy from them.
Yes.
Yeah,
So,
they do quite a lot of big trips.
It's about making them see that this is just not enough. Like, so if something would happen to you tomorrow, what would happen to your family? Would they have to now sell? Do they own the place where they live?
Yes. Yes.
Yeah. They still have a mortgage?
Yes.
Yeah. So they probably have to sell.
Oh, definitely. And then they'd have to move farther away. And if it was he that passed away, then she would have a much longer commute to get to her job.
Yeah.
Because her commute right now is like 20-25 minutes. And if they'd have to move to, say, Mission
to find something more affordable, they need to be even further out from.
And then the commute would be over an hour, and that's a lot of gas too. I know I explained how it would be if one of them, their income was no longer available, but they were just stuck on the whole idea that it was for paying for the funerals, and they didn't think they needed $200,000 to pay for the funerals.
Yeah, life insurance is more than just paying for a funeral. If your whole purpose of your life insurance is just to pay for your funeral, then get a plan like True Stage, that we have in Canada available for our clients, that is prepaid funeral insurance. But life insurance is a lot more than that. It is to protect your loved ones and their well-being after you're gone. Because losing a parent when you're a young child, or losing a spouse, especially when you still have young children, it's traumatic enough to have lost that loved one. But when on top of that, now your whole life needs to get turned upside down. You need to move from where you are, downsize. The kids end up in a different school districts. They need to make all new friends. Like, it's just so much emotionally for that family, that added stress. And even if someone cannot afford like the whole amount, our needs analysis shows that they need like $1 million coverage, which is $1 million, people think, wow, $1 million. When you think about it, like, because this life insurance is not just like for 1 year, like this is replacing your income for many, many years to come. So $1 million is not that much. No. But even if they would get like 200,000 or $500,000, at least it buys them time, and it's better than having no coverage at all. At least the family, because if they only have that, insurance that covers the funeral, for example, well, their life will be turned upside down right away. They won't really have time. Like if they would get like a term policy for at least a couple 100,000, even 100,000, it buys them time to figure something out. Like then in your case, Jacqueline, if that lady would pass away, well, then maybe the husband would think, well, maybe stock trading is not the best career path and I need to find something else as well to supplement my income. But it gives him time to do so. And same with her, like if something would happen to him, it buys her time to figure things out. Or it would at least, like, maybe she could give a bit of a down payment, like bring down the mortgage, reduce the monthly payments. This still helps. But if all they have is that final expense insurance that you said doesn't even cover their final expenses, their whole life would be uprooted in an instant, on top of the whole emotional pain of going through that loss.
Annie, what do you think about doing term instead of permanent for that 69-year-old woman that I have? Because she wants something for her son who's not, like, she wants to make sure that her son is taken care of. And I'm just thinking now, like, if we did except she's 69, so if you do 20-year term, 89?
Yeah, that would take her to 89. I would be more towards maybe a term 100. It's cheaper than whole life because it doesn't have that cash value.
Yeah.
But I feel like a term 20, like 89, a lot of people make it to 89 now. And she's
sort of gambling,
female, so even more chances of her making it past 89. And we wouldn't want her to pay for something and then outlive it, not get anything out of it. Right?
Yeah.
Yeah. Like if it's young children that are involved, then a term 20, well, at least you know the children are older, financially independent. Okay, I'm assuming her child is also older because she's 69, but her whole goal of this policy is to leave something behind for him.
Yeah.
So then we want to make sure that happens. So I would hesitate, like a term 20, I think there's too much risk of her actually outliving it.
Yeah, and you probably can't get a term 30 at 69.
I don't know.
Yeah.
Maybe.
Yeah.
It would be, well, it would end up being the same as a term 100.
Yeah.
I don't think because that would take her to 99. So it would be, or maybe just final expense. Yeah. But sometimes it depends on the carrier. Final expense sometimes is more expensive than a term 100. Depends on the carrier, but yeah, Cami, looking at a final expense policy.
Yeah.
But yeah, I would look into
term 100. Yeah.
Term 100.
Just because
final expenses, well, in Canada at least. In the US, I'm not quite as familiar. But I know in Canada, a lot of final expense policies are whole life policies. So they tend to be more pricey. And many final expense policies, they're simplified issue or guaranteed issue. And because of that as well, the premiums are a little bit higher than if we go through like regular underwriting.
I was also trying to avoid regular underwriting with her because she wants something to be wrong with her, even though there isn't. I mean, she talked an awful lot about a heart murmur that she doesn't have.
Yeah. But what I would do, like company, like in Canada, a company like CPP or Assumption Life, you can go through that questionnaire ahead of time and see how much coverage. And if they make it all the way to that questionnaire and they answered no to every single thing, then chances are you could just go through regular underwriting. Yeah. So for Assumption is just when you log into their site, you can go through the questionnaire there. I can guide you through that later if you'd like.
Okay.
And with CPP, I believe there's an actual questionnaire that you can download So if you go in the back office under platinum carriers, go to CPP, you might be able, it's called an A to Z or something
Yeah.
like that. You can download that questionnaire and then you can go through the questions with the client. And that way, if it was no, like all the way through, then you could consider just regular underwriting
Okay.
and be able to get a little bit more coverage for the same price. Yeah,
Yeah, thank you.
no problem. Any other objections people have had to deal with that they'd like to bring up? If not, well, we can finish 10 minutes early. I wish everybody a great weekend. And we'll see you next Friday.
For more awesome content, like and subscribe now.
We are the Icebreakers team. Our team writes more business per licensed agent than any other Experior Financial Group team in both the US and Canada. We are also the fastest growing team within Experior Financial Group in both the USA and Canada. We have full modern training in English, Spanish, and French. For more information on how to power up your life insurance business through joining the Icebreakers team of champions, contact the person that sent you this video or scan the QR code. Thank you for watching and see you next time.